Okay, let's unpack this. I want you to picture this scenario. It is 3:00 a.m. on a Sunday.
Right.
Wall Street is locked tight. The banks are closed. The physical commodity markets are pitch black. But sitting on your phone, you have just opened a massive 10x leverage position on physical gold.
And you're just watching the price tick up and down in real time.
Which, I mean, that shouldn't be mechanically possible.
No, absolutely not.
So if you've ever wondered how a scenario like that actually functions without the entire financial system just completely imploding, well, that is our mission today. We are doing a deep dive into a stack of technical documentation from the decentralized exchange Lighter.
Yeah, and it's a dense stack of docs.
Very dense. We are decoding the incredibly complex engineering they use to make traditional real-world assets, or RWAs, tradable 247 on the blockchain.
Because for someone like you, a learner trying to understand the actual bleeding edge of modern finance, it's really not enough to just know what assets can be traded on a platform.
Right. You need the why and the how.
Exactly. You have to understand the underlying plumbing. You have to know how the math and the market structure prevent the exchange from collapsing the moment the traditional guardrails are removed.
Right.
We're talking about maintaining precise, highly liquid markets when the rest of the financial world is literally asleep.
So let's start with the sheer scale of the universe Lighter has built here, because they aren't just trading crypto coins. The market specifications detail this bizarre, fascinating collision of worlds.
It really is.
You have physical barrels of WTI, crude oil, and copper sitting right next to major tech equities like Apple and Microsoft.
Right.
And you have foreign exchange pairs like the euro to the US dollar.
Yeah.
It is this massive umbrella over traditional finance.
And what stands out in the documentation is how Lighter manages the inherent risk across that vast, diverse portfolio. Like, they use strict open interest caps.
Meaning they don't just open the floodgates equally for every asset, right?
Right, exactly. So gold, which trades under the ticker XAU, has this massive $100 million open interest cap. But copper, on the other hand, is capped at $10 million. They mathematically restrict their risk exposure based on the underlying liquidity profile of the specific asset.
Well, amidst all those traditional assets, there was one specific detail in the specs that made me do a complete double take, the H100 index.
Oh, yeah. That one is wild.
Lighter has built an index that literally tracks the real-time hourly cost of renting an NVIDIA H100 AI graphics processing unit across global cloud providers.
It's brilliant, really. They're utilizing an external oracle called ORN to feed that specific data into the blockchain.
It's like turning computing power into the new crude oil.
Basically, yeah.
The $10 million capped market just for the rental costs of AI computing. But looking at this entire setup, this sort of 247 global casino, I have a major pushback.
Okay, let's hear it.
Traditional markets do close. Like the spot market for gold is offline on a Saturday.
Yes, it is.
So if I am that trader with a 10x leveraged position on gold over the weekend, how does the exchange survive that? Don't they force me to reduce my risk?
Surprisingly, no. The Lighter rules explicitly state that your leverage does not change outside of standard trading hours.
Really?
Yeah.
Yeah.
If you hold that 10x long position on gold on Friday afternoon, it remains completely unchanged over the weekend.
Wow.
There is zero requirement for you to reduce your exposure just because the underlying traditional market went home for the weekend.
That sounds incredible for the trader, but absolutely terrifying for the platform's risk manager.
Oh, for sure.
Yeah.
Which is why the documentation includes a very specific warning to users. Price volatility may increase dramatically at market open.
Oh, okay.
Because think about it, if the traditional markets gap up or down over the weekend due to some, global news event, your 10x position is going to feel that massive shockwave, the absolute second traditional liquidity returns on Monday morning.
Right, the moment the bell rings.
Exactly. So to handle that danger, liquidity and liquidations on the platform are aggressively managed by the Lighter Liquidity Provider, or the LLP.
The LLP.
Right. That's essentially the platform's insurance fund and market maker stepping in to ensure the whole system remains solvent.
Okay, but if I am holding that heavy leverage over the weekend, I need to know what numbers I am actually looking at on my screen.
Right.
Where exactly is the price coming from when Wall Street is asleep?
And that is the core engineering challenge of tokenizing traditional assets. Lighter utilizes what they call the RWA pricing mechanism.
Okay.
During normal hours, primary prices come from robust external oracle feeds. They use heavy hitters like Pytholaser, Chainlink, and Stork.
Sure.
But when those external markets close, those oracle feeds go stale. They stop updating.
Right, because there's no new data.
Exactly. And when that happens, Lighter shifts to a system called internal pricing.
And here's where it gets really interesting, because they don't just, like, flip a hard switch from external to internal. It's a mathematical curve.
Yeah, it's a gradual fade driven by an exponential decay formula.
Which is pretty complex math.
It is. But to visualize this, imagine you're driving out of a city listening to a strong, clear radio station. That radio station is the external oracle price. As time passes and you get further from the city, that signal starts to fade, right? And your car radio slowly starts blending in an internal pre-recorded track.
Right, so it's a mix for a while.
Exactly. The system trusts the outside oracle less and less as time ticks by and hands more and more weight to its own internal pricing mechanism, which is driven by the trading activity happening directly on Lighter's order book.
And the speed of that fading radio signal depends on the type of price you were looking at.
Correct.
Like the documentation points out that the general index price uses a 30-minute smoothing time constant.
Yeah.
But the mark price uses a much faster 2-minute time constant.
Yeah.
And just to clarify for you listening, the mark price is the critical number.
It's the one that matters.
Right. That is the official price that determines if your account gets liquidated and you lose your money.
And the difference in those speeds is very intentional. The platform needs the mark price to react rapidly to actual trading conditions to protect the system's solvency, hence the 2-minute fade.
That makes sense.
And the moment Wall Street wakes up and that external oracle radio signal blasts back at full strength, the internal price instantly snaps back to converge with the external data.
Hold on. Let me play devil's advocate here for a second.
Sure.
If they are relying on internal pricing for 48 hours over a weekend, aren't they essentially just hallucinating a price based on whatever traders happen to be doing on their specific order book?
Well,
Isn't that incredibly risky? What stops a massive whale from aggressively buying up the thin weekend order book, artificially pumping that hallucinated internal price, and liquidating everyone else?
that would be a catastrophic flaw if the internal price were unbounded.
Right.
But Lighter builds in a vital mathematical safeguard. The internal pricing is strictly bounded relative to two factors:
Which are?
the last known external oracle price from Friday, and the maximum leverage allowed in that specific market.
So it's not a free-for-all.
Not at all. Think of the last known Friday oracle price, like a heavy steel stake driven into the ground.
Okay.
The internal weekend price is a dog on a leash attached to that stake. The length of that leash is determined by the market's leverage.
Oh, interesting.
Yeah. So if you're trading a market with 10x leverage, that mathematical leash is exactly 10% long.
Got it.
The internal price can wander around the yard based on weekend trading activity, but the math mathematically chokes it if it tries to run further than 10% from that Friday closing price.
So it mathematically caps the hallucination.
Exactly.
If bad actors try to manipulate the book to trigger fake liquidations, they hit that invisible wall. It creates a fenced-in playground for traders while Wall Street is completely offline.
It really is an elegant solution to weekend price discovery.
Okay, so we've seen how they handle a sleeping market with that mathematical leash. But what happens when there is no underlying market at all?
Ah.
I want to look at the wild west of the platform, the pre-IPO markets.
The pre-IPO markets represent the absolute most aggressive application of this decentralized infrastructure. We are talking about users actively trading companies like SpaceX, OpenAI, and Anthropic before they are actually public entities.
But OpenAI isn't public.
No.
There is no stock ticker. There is no official share count. How on earth do you price a leveraged trade on a company that technically has no public shares?
Well, because these are private companies, Lighter basically has to invent the foundation.
Okay.
They assume a total flat share count of 1 billion shares for every pre-IPO market to create a standardized baseline.
Oh, wow.
And remember that whole external oracle discussion?
A radio signal.
Yeah, it doesn't exist here. There is no outside signal to tune into.
None at all.
None. These markets operate entirely and permanently on the internal pricing mechanism. Furthermore, the documents explicitly state there are no price caps.
So no leash.
No leash whatsoever. Pure, unadulterated price discovery. And because of that extreme volatility, they operate strictly in isolated margin mode. You cannot use the profits from your safe gold portfolio to backstop the massive losses you might take betting on SpaceX.
That makes a lot of sense. So they remain in that high-risk state until the actual IPO happens.
Exactly.
And at that point, they settle based on the official, fully diluted share count, which the platform announces one day prior to the public launch.
Right.
But Going from companies that don't exist yet to currencies you might not hold, we have to look at another quirk in these docs, the non-USD quoted perpetual contracts.
Specifically, how they handle major Korean equities like Samsung and Hyundai.
Yeah. The documentation outlines that these contracts settle in USDC, which is a US dollar stablecoin.
Right.
But the reference price tracks the underlying asset's performance in Korean won.
It's a bit of a mind bender.
It is. To visualize this for you, it's like buying a high-rise commercial building in downtown Seoul, but your broker forces you to pay for it using US dollars. You hand over the dollars, but the actual value of your investment, your profit or loss, is completely riding on the local Korean won real estate market and its currency fluctuations.
Yeah, and if we connect these mechanics to the bigger picture, both the Korean equities and the pre-IPO markets illustrate a massive transfer of risk.
How so?
Well, think about those pre-IPO markets. Because there's no external oracle, no price cap, and no historical data, the volatility potential is just staggering.
Yeah, it's huge.
So who is actually taking the other side of that risk? The LLP, the platform's insurance fund, is acting as the primary market maker in these highly speculative environments.
They are providing liquidity in a total void.
Exactly. And because the LLP is taking on that immense danger, the documentation makes a very clear point liquidation fees still apply in pre-IPO markets.
Oh, interesting.
This is fundamentally different from standard pre-launch markets on other platforms. Lighter's system is actively charging a premium because it's keeping the lights on in an environment where no traditional market maker would ever dare to tread.
Okay, so pre-IPOs eventually go public. That is a massive one-time settlement event.
Right.
But how does Lighter handle an asset that never stops expiring, like an equity index?
Yeah.
Like, how do they simulate a never-ending spot market for things like the S&P 500 or the NASDAQ?
That brings us to what we might call the index illusion.
The index illusion.
Yeah. So Lighter offers continuous trading on the US 500 and the US 100, which track the top 500 and top 100 US companies.
Right.
But they aren't actually tracking the spot price directly.
And the docs reveal the trick here.
Yeah.
Lighter derives these index prices from traditional futures markets.
Yes.
Because traditional futures trade 23 hours a day, 5 days a week, so they provide a great constant data feed.
Right. It's a solid stream of data.
But here's the problem. A futures price is inherently different from the actual current spot price of the stock market.
Because a futures contract inherently prices in the cost of time, the cost of capital, and interest rates until its expiration date.
Okay.
So it usually trades at a slight premium to the current spot market.
Wait, slow down a second. If the futures price is technically always wrong compared to the actual spot price of the S&P 500, aren't traders just, getting ripped off?
It sounds like it, right?
Yeah. How is Lighter using a skewed futures price to offer a fair spot trade?
They run a mathematical gymnastics routine to constantly realign that futures price. It's called the premium calculation.
Okay, break that down.
Lighter samples the premium the front month future has over the spot price. They compute a 3-day average of that gap and then calculate what they call a premium slope.
Which is expressed in the docs as basis points per day.
Exactly. Think of that slope like a subtle mathematical gravity pull.
Gravity pull, I like that.
Yeah, it is constantly and visibly pulling the futures price down so it matches the implied spot price in real time. They run this calculation and adjust the gravity every single day during the 5 p.m. Eastern Time gap hour when traditional futures briefly pause.
But if I'm sitting there at my computer trading the US 100, how do I actually know if the price I'm seeing is fair?
That's a great question.
Because given all these invisible mathematical slopes and gravity pulls happening in the background, how do I know the exchange isn't just tilting the odds in their favor?
And it is a vital question for any learner navigating decentralized finance. Lighter addresses it through radical transparency.
Yep.
They provide a specific API endpoint called synthetic spot info.
Just right out in the open.
Yep. Anyone can query it at any moment. It tells you exactly what underlying futures contract is being used, say, a contract named NMM6.
Wow.
It tells you the oracle provider, like PithLaser. It gives you the exact expiry time in milliseconds. And most importantly, it gives you the exact basis points per day slope they're currently using to adjust your price.
So you don't have to trust the exchange. The math is completely public for you to verify.
Exactly.
I love that level of visibility. And the docs also explain how they handle the actual expiration of those futures contracts.
Right. The roll?
Because futures expire, they eventually have to roll to the next month's contract.
Yeah.
For the equity indices, Lighter just rips the Band-Aid off all at once. The roll from the expiring future to the new future happens directly at the Friday close.
Right. It gives all the market makers and participants the entire weekend to adjust their quoting strategies before the new week begins.
It's a sharp, clean break while the market is paused.
Exactly.
So the S&P 500 futures rip the Band-Aid off on Fridays. But I assume a physical barrel of oil doesn't work that way? Let's talk about the slow fade.
Yeah, the futures contract price rolling mechanism for commodities.
Quite a mouthful.
It is. This covers assets like WTI crude, natural gas, Brent oil, wheat, and copper. This mechanism is where the frictionless digital world collides head-on with the messy physical world.
Because instead of an instant switch on a Friday afternoon, Lighter uses a grueling 5-day transition window.
Right.
It happens strictly between the 5th and 10th business day of the roll month. Every single day, exactly 20% of the price weight shifts from the current month's expiring contract to the next month's fresh contract.
And the documentation provides a very clear schedule of how this plays out. They use a hypothetical June 2026 roll schedule as an example.
Okay, let's hear it.
On July 8th, at exactly 5:03 p.m. Eastern, the price is weighted 80% to the front month and 20% to the next month.
Right.
The next day, July 9th, it shifts to 60-40. By July 10th, it's 40-60. By July 13th, it's 20-80. And finally, on July 14th, the transition is complete at 0% front month and 100% next month.
So to visualize this, it is exactly like a DJ slowly crossfading two songs over a 5-day festival set.
Yeah, that's a perfect way to put it.
You don't get a jarring, sudden jump in the beat. The old track slowly fades out while the new track gradually takes over the main speakers.
And this raises an important question, though. Why use a 5-day DJ crossfade for oil and wheat, but a sudden weekend snap for the S&P 500?
Yeah, why the difference?
It comes down to the physical reality of the assets. Commodities deal with actual physical delivery.
Barrels of oil, bushels of wheat.
Exactly. We are talking about massive global logistics cargo ships moving millions of barrels of oil, freight trains moving tons of wheat. As a physical futures contract approaches its expiration, those logistics cause the price of that specific contract to behave erratically.
Oh, I see.
If Lighter ripped the Band-Aid off all at once for oil, traders holding leveraged positions would be subjected to massive synthetic price shocks.
Which would be a disaster.
Total disaster. So by smoothing the transition 20% a day, they protect the traders from the friction of the global supply chain.
It is truly incredible when you step back and look at the whole picture.
It really is.
The immense, invisible machinery required to make this 24/7 dream a reality is just staggering.
Yeah.
You have exponential decay algorithms fading radio signals to hallucinate bounded prices when Wall Street is sleeping.
Yeah.
You have basis points per day premium slopes constantly applying gravity to pull futures back down to spot reality. And you have 5-day DJ-style crossfades managing the physical friction of global oil shipping.
And that is exactly why we dive into these technical documents. Because for you, listening to this, understanding this plumbing does significantly more than just make you a better trader.
Right.
It gives you Neo in the Matrix vision.
I love that.
You stop looking at a price chart on your phone as just a given fact, and you start seeing the active real-time construction of that price.
Yeah.
You see the machinery hiding behind the numbers.
EO in the Matrix vision, yeah.
Yeah.
And it leaves me with one final provocative thought for you to mull over. We've just spent this entire deep dive looking at the heroic engineering crypto platforms used to simulate traditional finance.
Right.
Working around market closes, managing expiring futures, building synthetic spot prices for pre-IPO unicorns.
All of it.
But as these tokenized 2047 markets grow exponentially, you have to wonder, will we eventually see the reverse?
Oh, wow.
Will the New York Stock Exchange and the traditional commodities markets eventually be forced to abandon their 4 p.m. closing bells?
That's a fascinating thought.
Will the old guard have to adopt crypto's continuous internal time-weighted pricing models just to stay relevant? Because once you get used to trading a barrel of oil or a share of SpaceX at 3 a.m. on a Sunday, that Monday morning opening bell starts to sound an awful lot like a relic of the past.